Things feel different at the start of 2026. Crypto markets were once driven by noise, constant hype, overnight pumps, and people chasing the next big thing. But that era is fading. What's happening now is far more deliberate, structured, and calculated. For years, XRP holders waited for a clear signal that the asset was more than just code caught in a legal battle. That signal has finally arrived, but not from a courtroom or a retail frenzy. It came from the highest levels of the global financial system. A research note from Franklin Templeton, a firm managing over $1.6 trillion in assets, began circulating among institutional desks before reaching the public. At first glance, it looked like just another routine report. But once analysts broke down the language, it became clear this wasn't a casual update. XRP was no longer described as a speculative asset. Instead, it was framed as fundamental infrastructure, language reserved for systems meant to endure. That shift matters. It reflects a deeper change in how serious capital now views XRP. This is the type of moment long-term strategists prepare for in advance. The transition from hype to structure, from market noise to institutional positioning, is already underway. The focus is no longer on chasing trends, but on understanding how institutions think, allocate capital, and build durable strategies over time. Researchers have tracked this transition from retail speculation to institutional necessity for years. The timing of this report was intentional. It followed the launch of spot XRP ETFs in late 2025, including Franklin Templeton's own product. When a major asset manager publishes research to support a new financial product, it signals commitment, not curiosity. At this stage, the market isn't being observed, it's being constructed. Franklin Templeton doesn't issue reports for casual traders. Their work is designed for pension funds, sovereign wealth funds, and large family offices. That's why XRP wasn't presented as a ticker symbol. It was described as a necessary component for modern financial infrastructure. That distinction is critical. It shifts the narrative from short-term price excitement to long-term value based on utility. Institutional investors care about how money moves in the real world. They need assets capable of handling global transaction flows at scale. According to the report, the XRP ledger was built for exactly that purpose. By labeling XRP as a foundational building block, Franklin Templeton signaled that its clients require exposure to it in order to maintain a complete and diversified digital asset allocation. This represents institutional validation that Ripple has been working toward for more than a decade. At this point, the retail-driven era of XRP is ending. The institutional era has begun. The largest money managers have already completed their due diligence. After evaluating speed, cost, and settlement certainty, they've concluded that XRP is uniquely positioned to connect traditional finance with modern blockchain infrastructure. This isn't about short-term price spikes. It's about XRP becoming a structural component of global banking. For years, XRP was driven by community narratives, legal uncertainty, and speculative excitement. By late 2025, that changed. Capital flows told a different story. While Bitcoin ETFs experienced major outflows, XRP-linked products saw hundreds of millions in inflows, driven not by fear of missing out, but by professional allocation decisions. Institutional investors are no longer choosing between Bitcoin and Ethereum alone. they are allocating capital to technology designed for specific financial functions. XRP, targeting the massive cross-border payments market, fits that requirement precisely. This marks the beginning of XRP's institutional breakout phase. Still, realism matters. Institutional interest does not guarantee instant price explosions. This is a structural transition, not a shortcut to wealth. Long-term optimism must be paired with discipline and patience. When experts discuss dramatic price scenarios, they're not describing fantasies. They're modeling liquidity requirements at global scale. If even a fraction of cross-border transaction volume moves through the XRP ledger, current prices simply don't support the necessary liquidity. That's the math institutions are now analyzing. Yet markets don't move in straight lines. Volatility, corrections, and shakeouts remain part of the process. Strong fundamentals do not eliminate risk. The real transformation happening now isn't flashy. XRP is becoming something far more important and far less exciting on the surface. It's turning into a quiet, essential layer of the financial system. Those who focus only on headlines and price targets miss the bigger picture. Understanding why the market is shifting matters more than guessing how high prices could go. This transition favors patience, planning, and perspective. Most participants won't have the discipline to stay positioned long enough to benefit. But for those who do, the structural shift underway could redefine how value moves across the global economy.